Preliminary GDP numbers came in at 2.9% growth for Q4 2022. So we avoid the recession or the start of a new bull market, right? I mean, we just had the seventh Santa Claus rally in a row, despite all odds. The first 5 trading days of the year were positive. The first month of trading for the year was positive. And per Business Insider, the other times this has happened, well, stocks were higher 100% of the time 1 year later. And just today, the S&P hit the golden cross. The 50-day moving average closed above the 200-day trend line for the first time since March of 2022. And you know, the S&P, it fell 20% in 2022, a huge market downturn that I predicted on this channel in the January 3rd, 2022 video. You know, the 9 times after this trifecta occurred, immediately following a deeply negative year, the S&P, well, it returned an average of 27%. So with this golden cross, is it time to buy into the market? Well, I think we're at the start of a bull trap for many reasons. And I'll talk about why in just a second. But first, let's see how that GDP number breaks down. Note the growth in auto parts. And that automobile manufacturers primarily make money, not from car sales, but from auto parts, service, and financing. That's true even for Tesla. You know, this is really good news for the auto sector. They had negative growth for the last 2 quarters, so this upturn is positive for them. Meanwhile, the fixed investment dropped by 1.2%. And most of that drag, well, it came from the reduction in residential investment, which dropped by 1.29%. The change in private inventories, it accounted for a 1.46% change that buoyed the gross private domestic investment to a total 0.27% growth rate. And finally, notice the government spending. It was up across the board. State, federal, and local governments are spending more this quarter and last quarter than the previous year. Let's look at consumer debt for just a second. You know, on the last macro update, I mentioned that revolving credit card debt was at an all-time high in raw numbers, and that the consumer was near capitulation. But how in the world could I think that when the ability to service debt, aka revolving debt payments as a percentage of disposable income, and the rate of delinquencies indicates that, at least from a pure numbers perspective, the consumer can run up debt for a while before hitting that hard limit? Well, it's because I don't think we're going to hit that hard limit. There's a phenomenon, a psychological phenomenon in economics called the wealth effect. This effect causes people to feel wealthier and thus spend more money whenever their stocks and other assets go up. And of course, there's a corollary reverse wealth effect that when stocks and other assets go down, you feel poor and stop spending. And there's a similar thing that happens when inflation hits inelastic goods like energy and food. You know, the consumer tends to overestimate how much this impacts their budget and reduces spending accordingly. Since inflation in energy and food isn't going away anytime soon, this should compound with the recent drop in the stock market. Yeah, it's up in the very short term, but over the last year, remember, it's still down. It's just compound with the drop in the stock market and layoffs in the economy to cause the consumer to reduce spending even further. And you know, if you look at the monthly numbers like we did on the last update, you can see the start of this decline in November and December of last year. Spending went down at a time when it's usually the highest of the year, just like I predicted in another update last year. Let's look at the services PMI. You know, if our economy is doing well, then we should see some growth here. But instead, we see a huge red flag. About 70% of our GDP, it comes from the consumer market, which means most of our consumer spending at the moment is in services, just like I predicted this past summer, the big shift in the services. So if the ISM services PMI leading indicator is going down, well, that's a bad sign for our economy. And it's not hugely negative now, but it is more negative than would indicate a bull market. You know, what's crazy about this is we hit an all-time high in spending on food and entertainment in November. So where exactly did that services drop come from? Like, where are people reducing the services? The BEA's GDP numbers tell a much different story than these spending numbers. It's confusing, to say the least, if not outright lies on those GDP numbers. So here's a chart on spending based on income bracket. Note the big jump in October. If the Q4 GDP numbers are correct, then it's because these 100+ K a year households went bonkers crazy on spending in October, probably trying to get ahead of the interest rate hikes. The narrative for a soft landing is growing, but the start of a recession almost always looks like a soft landing, which is where we're at right now and why these numbers are going to be more conflicting than normal. But back to why I think we're at the start of a bull trap. Per Bloomberg, almost 2/3 of U.S. consumers are living paycheck to paycheck, and that's up 3% from just a year earlier. It's not a surprise since inflation adjustable disposable incomes are still below the level at the start of the pandemic. And what this really means is that most consumers simply haven't had any real income gains in about 3 years. The longer real wages remain flat, the more that reverse wealth effect compounds because the consumer sees their credit card debt going up and their income isn't going up. So it's got to come to fruition at a certain point. There's an awful lot of overloaded camels out there right now, and it's starting to rain straw. Amazon is a bellwether for the good side, and per MarketWatch, they had their least profitable holiday quarter since 2014 and its worst annual loss on record. Amazon was expected to post a loss for the whole year for the first time since 2014, but worse than expected holiday earnings actually led to the company's worst annual loss on record. They lost $2.7 billion. And note, Amazon has not lost more than $1.4 billion in a single year since going public in 1997, and according to FactSet and MarketWatch. So why do I think that food and energy prices won't return to normal anytime soon? Well, it has a lot to do with globalization and the war in Ukraine. The food and energy markets are very global in nature, and so impacts are far-reaching. The United States is a large producer of food and energy, and we won't feel the impact as much as the rest of the world, but we will feel it. Since the oil market is linked to agriculture due to fertilizer and transportation costs, let's look at the energy market and how it plays out for Russia. The longer the war goes on, the more infrastructure goes offline in Russia, either due to damage from the war or lack of maintenance as resources are prioritized for the war. And when you look at the petroleum market in Russia, and Peter Zayan talks about this in one of his videos, Russia simply doesn't have enough native petroleum engineers of high skill. This is a problem because Russia is the second largest exporter of refined oil products in the world. As a matter of fact, only Saudi Arabia exports more. The logistics of the oil chain are bottlenecked in Russia. This means that because they can't export all their oil, they're likely producing more than they can ship, and that means they're starting to fill up storage tanks. But once those tanks fill up, they're going to have a massive problem in their energy and oil sectors because they're going to have to stop those well pumps, which are in subarctic conditions. They're going to have problems shutting down those well pumps safely because they lack the technical ability, and all the foreign engineers have left because of sanctions in the war. Between the bad shutdown, a lack of parts, and a lack of technical knowledge, this means they will have major problems restarting this capacity. And once that happens, it'll be years after the war ends before they can bring this capacity back online. This will have ripple effects in the oil, fertilizer, and food markets for years to come. So let's end this update with an interesting look at the markets. This chart shows that traders aren't adding leverage as we would expect to see at the start of a new bull market. There's a decent amount of cash on the sidelines waiting to take advantage of any major downturn in the markets, and even more available in credit. So when the market does turn back up, it's going to turn back up quick and pretty high. So does the golden cross indicate that we're at the start of a new bull market? Or are the long-term fundamentals right and we're in a bull trap? Tell me in the comments below what you think will happen next in the economic circus.